Okay, this video is going to focus on the first part of monitoring and controlling, which is the cash flow statement. But before we start that, we need to consider, okay, what actually is monitoring and controlling as part of the overall financial management process. Monitoring and controlling is really all about the key financial statements, so the balance sheet, the income statement, and the cash flow statement. And in terms of, what do those financial statements provide for a business, and how do they allow a business to effectively monitor and control its capital so that it's used appropriately and ultimately so the business can achieve its objectives. So from the perspective of the financial statements, what benefit do they provide to the business? Well, they give clarity around key objectives for the business in terms of profitability, key objectives in terms of things like gearing, solvency, and the ability to see what is the mix for this particular business between its current assets and its current liabilities. And that's of interest not just to that is of interest to all stakeholders. So those stakeholders could be internal or external. So internal might be management, employees. External could be prospective shareholders, existing shareholders, the government, the tax office. So any of those stakeholders, these financial statements are imperative because they allow them to monitor that particular business. For example, if it's a tax office, they can use financial statements to monitor them. What's their profitability? How much tax should this business actually be paying? And for other stakeholders, that might mean controlling them as well. So internally for management, allowing them to effectively control that particular business. Financial statements really provide a whole host of benefits to those people looking at them. Namely, however, those benefits relate to liquidity, so the ability to meet your short-term obligations, solvency, the ability to meet your long-term obligations, profitability, so see what's the net profit and gross profit of a particular business, and also how efficient is this particular business in terms of its accounts receivable or its inventory management. So the financial statements allow those calculations to be made, and also for it to be much clearer about how good is this business in relation to those four key areas: liquidity, solvency, profitability, and efficiency. Okay, so to start off with the cash flow statement, probably the statement that is looked at the least from a lot of stakeholders' perspective, but it is of critical importance, and it's very important to understand its role. So it effectively records cash inflows to the business, so that money coming in generally in the form of revenue, and that money going out in the form of expenses or costs to the business. And it's over a specific period of time. Generally, it would be over a 12-month period, but cash flow statement may well break that 12-month period down into smaller chunks. So it might be 6-monthly cash flow statements. It might be quarterly, so 3-monthly. It could be monthly, weekly, even daily cash flow statements if you really wanted to get into some serious detail in relation to cash flow. Cash flow statements are generally broken down to 3 key areas for operating activities, financing activities, and investing activities. Some statements will show those 3 key areas. For large public companies, that's generally the case. For smaller businesses, however, they might just lump all their cash flow activities into basically cash in, cash out. And for most of the cash flow statements we look at in business studies, that's the case, where it's just cash inflows and cash outflows. But for those businesses that are a bit more detailed, your operating activities are your general day-to-day business activities. Investing activities are just that, so cash flow that relates to investments for that particular business. And financing activities, the cash flow that relates to financing, so such things as borrowing money and the interest payments, the cash flow interest payments that relate to those financing activities. So here's an example of a cash flow statement. It's one we've looked at in class previously for Irish Toys. And just to highlight a couple of key aspects to it. Number one, an important part of a cash flow statement is the opening cash balance. So for this particular business, for Irish Toys, in October of 2015, this business started off with $11,000 in cash. That's how much they had cash sitting in their bank account at the start of October. Then they had some further cash inflows to add to that initial opening cash balance. And those cash outflows related to some cash sales receipts, $20,000. They got some interest of $1,000, and therefore some total inflows over that month of $21,000. Now, when added to the 11,000, you could say that their current cash balance then was 32,000. But of course, like any business, this business also had some outflows. So some money left the business, some that needs to be recorded, and they included supplies, wages, and you can see the rest there. So their total cash outflows is $17,000. So they started with 11, 21,000 came in over the course of this month in terms of inflows. Then they paid out $17,000 in form of outflows. Therefore, their ending cash balance at the end of that month was $15,000. So their opening balance plus the plus the inflows, which equals 32,000, 11 plus 21,000, less the 17,000, gives them a closing cash balance of 15,000. That closing cash balance, you'll notice, for October becomes the opening cash balance for November. And we go through the same process. We start with 15,000. They receive $36,000 over the course of that month, which means effectively at this point their cash balance is 51,000, the 15 plus the 36. But then they also had some outflows. $24,250 was paid in outflows, which means, again, the opening cash balance plus their inflows, less their outflows, means at the end of November they had $26,750 in terms of cash. Okay, and we do the same for December. The closing cash balance of November becomes the opening cash balance for December. Add the opening cash balance to these inflows, less our outflows, and that means at the 31st of December, the date up here at the top of the cash flow statement, as at the 31st of December 2015, this business's closing cash balance, just the cash balance, was $42,000. So it's an important statement because it clearly shows a breakdown of opening cash balances, cash in, cash out, and there is some overlap with some of the other financial statements, namely the profit and loss statement or the income statement, where some of these figures will be seen. For example, if we were doing a profit and loss statement as at the end of December, that closing cash balance of $42,000 would be the cash entry into the income statement for that business. Okay, so that is the cash flow statement in summary.